everyone. I wanted to start off with some of the basics. You're going to hear from some great fund managers about how to about some options for investing in your portfolio, but I wanted to start with some of the basics of how to build that portfolio. So I think if we the usual disclaimers that Roland has addressed there. So I'm going to assume that you're starting from the basics of where you've got some of your portfolio basics together. So you've decided on your asset classes, you've decided on whether you want to take an active approach with a fund manager or a passive approach where you're tracking markets, or a mixture of both. You've worked out who you want to invest with, and you have a plan and a goal for your retirement portfolio. There's a lot of information on the YouInvest and the Shares website if you want to supplement some of this and if you want to go over some of the basics. But I thought it would be useful to go through some of the mistakes that you don't want to make when you're building your portfolio. So the first one that we've got is not spreading your assets far enough. And so this is really a case of making sure that you don't have too much of your portfolio concentrated in one particular area. Now that could be one fund, or it could be a particular country, be it the US or the UK, or it could be an asset class. And typically UK investors tend to have a lot of money in the UK. They recognise the companies, they find it a bit more relatable, they even use those companies, and so then they tend to have what we call a home bias, where they have a hefty chunk of their portfolio allocated to UK stock markets. And another error that people can make is getting too wedded to one particular fund manager. So that might be a fund manager that has delivered very well for you in the past and has delivered you high returns, which means that that fund will have become a large part of your portfolio. Or it could become be a particular fund manager that you just have high conviction in. But where you've got a lot of your assets in one area, that increases the risk in your portfolio, because it means that a larger chunk of your portfolio is reliant on that one asset or that one fund or that one country's stock market outperforming. And if it underperforms, that's going to have a big impact to your portfolio. And I think the way you really need to think about this is to think that this is your retirement income that you're investing. This is the money that you're going to have to rely on in your retirement, and the amount that you have in that pot will also help determine when you're able to stop working and to retire. So you've got to bear that in mind when you're spreading your investments. So I thought it would be useful to have a look at what a split of the world's stock markets look like, and you can perhaps bear this in mind and think about how this relates to the particular split in country stock markets that you have within your own portfolio. Now, this isn't an exact science. This is how the MSCI World Index is split. So that is a broad global index that invests across different country stock markets and is split by the size of those stock markets. So what you can see in that little red slice there, that's about 4%, that's how much the United Kingdom makes up of global stock markets. This obviously isn't exact science, and it's not necessarily the exact model that you want to replicate with your portfolio, because about 70% of this is in the United States, and that in itself represents a bit of a risk. But I think it's a good resetter sometimes if you compare your own split of your portfolio to this. I think some people might be quite surprised by how little the UK makes up and how much it might make up in your own portfolio, but also other areas that people might not have thought about investing in. So I think it's quite good to compare this. And I think what we're talking about here is ensuring that you're getting a spread of returns, that you're going to capture returns from different markets, and that your assets are spread around the world. So I thought it would be useful to look at how markets have performed over the past 20 years. So what we've got here are some broad indices from different countries around the world. So we've got things like emerging markets, we've got the S&P 500 index, which is in the US, we've got the FTSE 100, which is the leading UK companies. And if we look over that 20-year time horizon, emerging markets have delivered more than 533% return during that time, and it's the standout performer over that long period of time. In contrast, the FTSE 100 has delivered about 184% return, so much lower than that. And the S&P 500, the US index, sits kind of somewhere in between with about 330% return. So then we can compare that to the short term. So this is looking at those exact same indices, but just looking at the performance over the past 2 years. And you can see here we've got a very different story. What we've got here is that emerging market index, which was, top of the charts in the previous one, has fallen to middle of the pack over the past 2 years, and it's returned about 19% during that time. The S&P 500 is the big, I guess, winner over this time, and that's returned 42%. And the FTSE 100 is dwindling at the bottom there with just almost a 3% return during that time. And so what I hope that these two charts show is the importance of spreading your assets around, of not having too much money in one area. So for example, you could have ended up with a lot of money in emerging markets if you'd invested over that past 20-year period, and it could become a big part of your portfolio, but actually over the past 2 years, it's not delivered as much as other markets. So it's just ensuring that you've got a spread across all of these different markets, so you're capturing those different returns at different times. So that leads nicely into the second mistake, which is chasing returns. And I think this is something that a lot of investors end up doing at different points in their investing time. And it's really kind of rushing to buy when everyone else is buying. It's believing some of the hype maybe around some investments. What typically happens is you will rush to buy and then you'll end up buying after the peak, so after the investment has seen a big rise. And then as investors, it's very hard to sell. It's very hard to admit that you might have got something wrong if it's sitting on a loss, or it's very hard to not just cling on to the thought that it's going to keep going up because it went up before. And so then lots of people are often unwilling to sell when that investment is headed south. So I thought it would be useful to look at some examples of this. The classic one that lots of people will know is the dot-com rise. So this was the big boom in US tech stocks leading up to 2000, and the NASDAQ, the market in the US, went crazy during this time. Lots of tech stocks went soared in value. Even companies that just had .com in the name but weren't really tech stocks also got caught up in that, and lots of investors got caught up in this, believing that the stocks would keep on rising and rising. And this chart looks like your ideal investment. It's gone up by lots and it's just headed northwards. However, what happened just after this is this next slide, and this is after the crash, and this shows about a year onwards from the crash and how much markets fell during that time. And it actually took the NASDAQ about 14 years to recover to its pre-crash levels, which shows just how long investors would have had to have clung on for to be able to get back to that pre-crash level. So this is the classic kind of story of people chasing returns and then markets seeing a big fall. I thought we'd look at another slightly more topical one. Tesla, the motor company, electronic vehicle company. Lots of people think it's overvalued now. Lots of people think it's still got miles to go. I'm not necessarily going to cast a judgment on that. That's for you guys to decide as investors, but I thought it would be useful to look at its rise and its fall and then its rise again. So this chart shows the performance of Tesla's share price since IPO, and you can see it kind of ticks along away at the bottom for a while and then soars up. And what we've got here is the share price has risen during this period more than 11,000% since IPO. But then the pandemic markets fall here, lots of things fell, and Tesla fell by a large chunk. There were also then some concerns about its ability to produce vehicles, Elon Musk's slightly unorthodox style of management, some governance concerns, and the market, the share price fell off. But then if we look at this section up here, we can see the markets then soared again, the share price soared again. In the space of a month, the share price rose by 60%. So $448 billion was added to the value of the company, which that alone is the total value of all but 9 stocks in the S&P 500 index. So that is just a massive, some would argue, bubble. So if we compare the valuation of the company, the average stock in the S&P 500 index trades at about 24 times its trailing earnings. At the moment, Tesla trades at 365 times its trailing earnings. So this is another potentially cautionary tale of where investors have rushed in to grab a bit of that growth. And I will leave you guys to decide whether that growth is over or not. And I guess only time will tell. The third mistake I wanted to look at is going back to a kind of portfolio construction level, is looking at how much cash you've got in your portfolio. So what we've seen over the past few years during the pandemic is that cash savings have soared during that time. So this is looking at the amount of savings we all have with banks, and we can see that during that initial pandemic lockdown, it rose a lot, and it's still pretty high, and I think now is kind of stabilizing a bit more back to normal levels. However, during that time, average interest rates have fallen dramatically. There's some hope that they might go up, but they're certainly not going to go up dramatically in the near term. And so what we've also got at that time is this slide showing inflation. So the orange line here is what inflation is doing at the moment, sitting at about 4% at the moment, while interest rates are really low. And what that means is that any cash that you've got is earning a loss in real terms when we take into account inflation. That doesn't mean to say you shouldn't be holding any cash, but it means that you need to really think about the cash that you've got in your portfolio and whether you have too much cash. So this is kind of your cash checklist of what you need cash for and how much money you need to set aside in cash. So we advise people to have an emergency fund. So this is kind of 3 to 6 months of your essential household costs. And this is a pot of money that you can fall back on if you were to lose your job or see your income fall or hit another emergency. And that's money that you need to access readily, so you need it in cash. Then your next checklist is anything that you need to spend in the next 5 years. So this could be smaller things like holidays, for example, or maybe slightly larger if you need to you need to buy a new car during the next 5 years. You'll probably want to set that money aside in cash. Maybe if you're moving house, things like that, anything that you're going to need in the next 5 years is probably better left in cash. And then any money you want to take absolutely no risk with, because obviously investing comes with risk. But once you've checked off these checklists and kind of worked out what the value of those things is, you then want to look at how much you've got sitting in cash in your portfolio and how those two figures tally up, and whether you could perhaps put more in investing, put more in your pension, and take a bit more risk with some of that money, considering those previous charts of kind of interest rates and inflation. And so then the fourth mistake I wanted to touch on is buying the wrong unit in a fund. This is a bit more of a technical one, but it's definitely a crucial one when you come to buy a fund. So there's a lot of confusing letters and acronyms and terminology after funds often, and there'll be different share classes of it. But I think the one that I want to focus on is where after a fund, typically it's an income fund, it will either have INC or AC after the name. So INC stands for income, and that means that all income that the fund generates will be paid out to you. AC stands for accumulation, and that means that that income that the fund generates is automatically rolled back up into the fund and reinvested in the fund's assets. There's no right answer to this, but it depends whether you want the income now or you want more gains later. And I think if you're at the stage of you're building your retirement portfolio and you don't need that money just yet, then what you want is that money accumulating up, most likely. You most likely don't need that income at the moment to be paid out, but that's a judgment call for your own personal circumstances. I thought it would be useful to look really at the difference this makes, because this feels like a very technical aspect, but actually it can have a dramatic impact on the returns in your portfolio. So if we look at this chart here, so this chart shows a top performing UK income fund, and the blue bars are the AC share class, so the accumulation where that income has been rolled up into the fund, and the orange one is the Inc. share class where that income has been paid out. And if we look at this, we can see that those bars start to kind of diverge after a year. But if we focus on that 10-year figure, I think that's what's really interesting. So this is looking at the return of that fund. With the income share class, it's delivered just over 100%. With the accumulation share class, it is delivered 215%. And that really shows the value of that income being reinvested back into the fund, compounding over that time, which effectively means you're getting returns on your returns, and how much that can then boost your portfolio ultimately. So what can seem like quite an arbitrary thing to pick when you're buying a fund, you've picked which fund you want and you think, oh, there's some different letters, but after this fund, I'll just pick one of these, actually can have a very big impact on your portfolio. And often it can be worth going back now and looking at which version of the funds you've bought and assessing whether you wanted to perhaps sell out of one and buy into the other, and assessing whether that is the kind of the right share class for what you need at this stage in your life. And then the final one may seem obvious, but it's not saving enough. And this is the biggest risk to your retirement portfolio, is not putting enough away. But I can understand that it's quite hard to think you're putting away a bit of money each month, you're investing that in different areas, but it's quite hard to relate that to actually how much money do you need at retirement and what size pot do you need to provide you that income in retirement. There's some calculators out there online where you can look at that and you can plug in some different numbers and see how that shapes up. But I thought it would be worth looking at this. So what income you might need in retirement, and so this is looking at the PLSA, which is kind of a trade organization looking at what they call their retirement living standards. So they've taken all aspects of your life in retirement and totted up how much they would cost. So things like meals out, holidays, your essential bills, and tried to look at what income you might need. And they've come up with 3 different versions. One that you'll see there is based on kind of covering all your essentials with a little bit left for fun, but you're certainly not going to be going out for meals every night or going on very lavish holidays, for example. And it's worth saying, sorry, these figures are based on a single person. If you're in a couple, then you don't need to double the figures because there's some kind of economies of scale and efficiencies. So it would be slightly less than double for this. So we're looking just at a single person because I thought that would be the easiest example. So if you can look at that kind of essentials one, that comes in at just under £11,000 a year, is how much you kind of need as an income coming in. Your next stage up is you've got a bit more financial security, you can afford a bit more things, you're not living quite so tightly, you can afford to buy a bit more luxury food, for example, you don't have to shop at a budget supermarket, things like that. And for that person, you need just under £21,000. And then the next one is a bit more of a luxury lifestyle. It might be what a lot of people picture that they're having in retirement. It's things like going on more than one holiday abroad a year, or going out to eat more, being able to buy presents for the grandkids, things like that. And that is £33,600 a year would be the income that you need. So these are kind of good ways of framing how much money you actually might need in retirement, but what size pot do you need to provide that income? So what I've done here is look at what size pension pot you would need to provide that income in retirement. I've assumed that your retirement starts at the age of 65 and that you need that pot to last until 90. That's obviously not a perfect science. Some people will live beyond that. Some people want to start their retirement early, but for the purposes of this example, I've kind of looked at that. And I've looked at you having a retirement pot that generates 4% investment growth each year that you keep invested once you're retired, and generates an income, and how long it takes for that pot to run out. So I'm running that pot until age 90. So for that essentials, £11,000 income a year, you would need about £180,000 pension pot by the time you come to retire at 65. For the kind of middle of the road one, bit more luxury, you would need £345,000 pension pot. And For the more luxury one, you would need £560,000 pension pot. Now, some of these figures might seem very attainable for some people. They might seem a bit pie in the sky for other people. But I think sometimes it's good to have a reference of what you're building up to, and that can help you shape your investment process and what you're investing in, and also how much you're contributing.